Okay, let's start. I will remove this. So, okay. Trading with Elliott wave principle by Gregor Horvat and Aleksandar Koprivica. My name is Aleksandar Koprivica, and Gregor and I will try to show you some examples and some setups for the live Elliott wave trading. If we are ready, we can start now with slides. As probably you already been to our previous seminars, Gregor Horvat is technical analyst and trader based in Slovenia in Maribor, and you can see here the resume of Gregor and me as well. I'm Aleksandar Koprivica, which is working with Gregor, and I'm technical analyst and trader as well. So you can read my bio as well, so you can see our background. Today we will start to explain a bit more deeper in Elliott wave methodology. So what should you do and which type of setup you should be looking for if you are trading live markets with the Elliott wave methodology. Okay, so what we will cover tonight or today, depends in which zones you are. Patterns good for a trading setup, where to enter a trade, where to put a stop loss, what is confirming price action, defining your own risk level or comfort level, defining your own risk, and we will show you some live analysis and trading examples recently from live markets. So, if you are a follower of Elliott wave methodology, or you would like to become one, of course you should know that besides theory, you want to know where actually you should be and how you should be trading with this methodology. We will divide this in a bull and bear market, so you can see both sides of the coin. And what you see now on the screens is the basic Elliott wave setup, which shows a primary fractal or a primary structure of the Elliott wave methodology on every time frame. But in this primary setup, you can find trades, of course, and like this, we are starting to. We are usually when we analyze the market, we are trying to define our entry and exit points on this type of price action. So as you see here, there is a set of waves. It's a wave 3, wave 5, wave A against the trend, wave C. You can see here basically the 1, 2, 3, 4, 5 ABC pattern, which marks 1, 2 on a higher time frame. And we noted here two bullish setups. If you see, it's on the end of the wave 2 and on the end of the wave 4 for the bullish trend. And if you want to trade ABC corrections, there is as well one more bearish entry here if you want actually to position yourself and go with the flow, with the market all the time. So what is important, if you look this structure, what is important for this? It is important you recognize the Elliott wave rules, because you know in these rules that wave 2 can never retrace 100% of the wave 1. So when you see a 5-wave pattern and or a 5-wave move on a time frame, you know that the wave 2 cannot retrace more than 100% of the wave 1. So what you actually want to position yourself, this current price movement gives you a sign that we are maybe going into a bullish trend and you want to position yourself to go long. Of course, you will try to position yourself not to go long here, but to see how deep retracement of the wave 2 will go, and then position yourself to go bullish or to buy market. There is different combinations here, of course. Depends on the simple or complex wave 2 structure. But anyhow, for you to observe the market and seek for the bullish setup, you need to know that this wave 2 can never retrace 100% of the wave 1, so you know where your stops will be if you want to go long. Again, most sweet trading, it's the wave 3, of course, because if you are getting long here, you will be catching up some of the wave 3. But in the case the trend is starting and you are not so sure if we are going to develop in a new bullish trend, you can always trade the wave 4 setup, which is a bullish trade setup as well, but this time on the second pullback or a second retracement in the first sequence. So you will wait wave 4 pullback, and then you can search for longs for the 5th wave. Here again, you should know the Elliott wave rules, because the wave 4 can never enter the territory of the wave 1. So your stops will be here below the wave 1, because beside that the count is not valid. So as you see, the point trading with the Elliott wave is to try to get the maximum gain with the minimum risk. That is the ideal, of course. On live market, it's not always like this. But if you like to trade with this methodology, it gives you an edge if you know where to put your stops, because it gives you the parameters with the wave 4 and wave 1 and wave 2. So if you're getting bullish here, of course, you know you have one more wave up, so you are not going to expect much. But anyhow, you can climb the trend by trading the wave 4 with your stops here. So as you see, your risk is not this, but this, and your gain is 2 to 1 or 3 to 1 in both cases. Of course, if you like to, as we say, drive the ride all along, after wave 1, you can expect the first primary correction in the wave 2 on a larger degree. If you like, you can trade as well this on the short side. But using the Elliott wave methodology, we always trade a wave B, because this is the confirming price action that we will have another leg down. There is, of course, very aggressive Elliott wave traders which try to catch a wave 5 high, but usually it is not recommended, because you never know when this high will occur. The 5th wave can extend. All sorts of things can happen. So if you want to trade against the trend, actually you have to wait the 5 waves down and confirm the reversal, and then you should try to catch the wave B highs. Again, your stop will be above wave 5. So as you see, again, the risk reward ratio goes in your favor. So you will try to catch the wave B 5 waves down in C. And then, of course, you will have to go out, because you know that looking at the whole structure, this is just a pullback. So in general, if you have a bullish market mode, you have 2 spots when your trades will be most risk-reward setup. You have to catch the wave 2 lows and wave 4 lows. Doesn't have to be necessarily the low, but what is important is that your stops are positioned according to the rules. On the bear market, same thing, but just reversed. If you see, we have 5 waves down and the correction. So if we are on the verge of developing a large trend on a daily, on a 4-hour chart, let's say this is a 30 minutes or 1-hour chart, you see the 5 waves down. You see first initial 5 way down, and then again your entries are here. You're trying to again minimize your risk and maximize your gain. So the stops will be here, and you will be trying to catch a wave 2 high. and then the same third wave will unfold, you will have another chance until the fourth wave will develop. And then you know that your stops are here. So basically it's the same thing as we talked before, just reversed. And then if you're trying to get on a fourth wave, you can get to a fifth wave here. Unfortunately, again, you don't know when this is going to finish. Nobody knows that. Traders likes to try to catch the lows or highs, but it is very advisable and very money saving that you try to wait again, confirming price action with the wave A and try to catch a wave B lows with the stops here, so that you can, if you want to trade the C wave up again. So basically, you have 1, 2, 3 entries. If you have any questions, you can type them in. I see them up. So if you have any questions during the explanation, please type them in. So this is the basic structure, but on any time frame. This can be, but usually we don't take small time frames because there is a lot of noise. What we look is, we go from daily to 4-hour to 1-hour chart, when we usually try to make setup for our trades, 30 minutes, 1-hour chart, but most usually 1-hour chart. Since that's the most, higher time frames have better confidence in trading, especially with Elliott wave, because the lower time frames can have a lot of noise and movements which you cannot predict. But something on 1 hour, for example, this structure, it's sure for trading because it is more solid. Behind, there is more in this case, selling pressure on a wave 4. It is more solid for trading than, let's say, 15 minutes or 5-minute chart. Setup patterns with high probability of success. As you know, if you're following Elliott wave methodology, you have in corrective patterns, you have zigzags, which is just so. This is here, it's a zigzag pattern. Flats, ending diagonals, which we'll not cover. We will cover them in the next seminar, and triangles. So these are the basic corrective patterns which you can use and identify the trade opportunities. Zigzags. Okay, as you know, every zigzags we are making here the simple zigzags. Has 5 waves down in A, correction A, B, C in B, and 5 waves down in C. And for example, if you are here in this pullback, you would like to climb with a trend on a larger degree. So if you like to trade on the bull side here, your entry will be above the wave 4 of the zigzag, and your protective stop will be below C. This is aggressive approach. It means that you are not going to wait complete confirmation of the change of trend, but you would like to catch it in early stages. So there is traders which are trying to catch this ABC move in the early stages, because later when you have a complex correction, this is important because this can turn into a wave X pattern, which means that the corrective move is still not over, so you will not get this bullish trend. Trading with patience, it's more advisable, since if you go over wave B highs, there is much more probability the market turn bullish, and that this entry has more chance to be in your desired direction. Again, if you have any questions, please ask. So depends on your profile. If you're an aggressive trader, you would like, some traders likes to catch the whole move. They don't want to wait. They're impatient, or they have such aggressive mentality in trading. They're going to wait this wave 4 to be out, and then go into the market, because they consider this momentum trading buying, and the trend will continue. And for the patience ones, which like to have a more confirmation, which trading with with a different type of let's say, mentality, you will wait this confirmation, which is much more surer than this one. Because of if we are above wave B in a 5 waves, there is almost 80 to 90% probability we are going to continue higher in a new bullish move. Okay, same thing, bearish market. If you look, it's just reversed. If you see this, it is again zigzag pattern, ABC, and the same positions, basically. Wave 4 of the wave C and protective stops are there. So again, it gives you a chance to choose, depend on your mentality or trading approach. In the same manner, we always recommend this type of setup because it will give you more reason behind to stay long with this. Here you have to be afraid because you don't know if this is going to turn into XW wave, and then your trade setup is not so good. You can grab a few pips, but fast you have to go out because this market will go in the direction of a correction more. But this setup will give you more confidence with the 5 waves down when the wave B is taken out. It will give you more confident setup for continuation. Okay, so if you have any questions, Gregor will show you now some live examples of this, what we just have explained. If you have just a few questions before, please ask so that Gregor's explanation will be more viable for you. Okay, no questions. So I will pass now the presentation to Gregor, which will show you the live examples and add something maybe which I have missed.
Hello everyone, my name is Gregor Horvat, and before we start, can you just confirm that you see my slides here and hear my voice well? Okay, so the Alex showed you the basics of these patterns, a zigzag. In both directions of the markets. So I will show you now one of my past examples of trade, which was taken on crude oil, and my step-by-step approach to trading setup. Okay, so on crude oil here, always when I'm looking for a trading setup, I of course firstly want to identify a trend. Okay, so larger trend, I don't have this chart here, but as you know, if you'll check at your broker, the larger trend for crude oil was down, is actually still down. So my interest is to look in the direction of a downtrend. Okay, so in such case, I always go to the smaller time frame to identify the pattern. Okay, so here we have the 4-hour chart, and I of course wanted to get involved in this downtrend, and obviously, if I want to get short, I firstly need to see pattern that I recognize. The counter-trend price action, the most common pattern is a zigzag that Alex just described here. Okay, so here on the 4-hour chart, we can see an ABC move to the upside. Okay, 5 waves up in wave A, wave B down, and 5 waves up in wave C. So at that time, this was just the analysis. Okay, my count was still not confirmed, so I still did not look for any entry numbers, okay, or any stop loss zone, profit zone, nothing. This was just my analysis. I was still waiting on more evidence that I'm on the right track. So I use Fibonacci tools, and I projected a potential reversal zone, okay, and the next probable move. Okay, so I was looking for a move to the upside, and then obviously was expecting a reversal. So at this stage, the most important question that you always need to ask yourself when you see the pattern is if the pattern is good enough for your money to invest into this market, okay? If the pattern is not clear, go and look at some other markets. If the pattern is clear, like here, as a pre-wave move, then obviously, yes, you could be interested in shorts. But as I said, you need some more evidences. So let's take a look on the next slide. So here, the market, as you can see, reversed from Fibonacci resistance zone. More importantly, it fell through this trend line of this corrective channel. And in fact, this decline to me is looking quite impulsive. And if you recall, Alex also mentioned that in aggressive approach, you will tend to see move through this wave 4 swing low that will confirm end of this move. Okay, so at this stage, I knew that I can pull a trigger here, okay, because I have a top in place. Even if this market will move just temporarily to the downside, it should make minimum 3 legs to the downside, okay? But ideally, the downside projection is much deeper, okay? Because, you know, if this will unfold impulsively and if we respect the larger downtrend that was the case on crude oil, then downside potential is definitely very huge here, okay? So, I knew exactly when to pull a trigger, if market will reverse impulsively, only then, because this is my confirming price action at the time. If the market will turn impulsively to the downside, out of this uptrend channel and through the wave 4 swing low, okay, then I will pull a trigger, okay, and I will enter a position at the market with a stop loss, obviously above the invalidation level, okay. So this is my confirmed price action, and I entered the trade. And I usually, of course, I have some projections, targets in my mind, but I really like trailing stops, okay, because market can always surprise you, okay. So you can never know what to expect from the market, especially in this room as shown here on this chart, okay, on the downside. So as you can see here later on, crude oil moved nosely to the downside, okay. As soon as I have spotted this sharp move to the downside, I obviously make my stops very tight. As you know, if the market is in wave 3, like here, then you will typically move stops into the territory of wave 1. But because this was a very strong move, I trade them much lower, above this 96.22, okay. And if I remember correctly, I also closed 50% of the position here, because at that time I was looking for wave 1, wave 2, and I thought that at this blue wave 3 low, it was already a fifth wave down. But as I said, I always like the trailing stops, okay. So I made stops tight, and you can see the market then continued even lower, and even at this price, as you can see on the chart at 92.30, I pulled them to above this latest minor swing high, and was still waiting for a potential further weakness, okay. If I will be stopped out on trailing stop, that's fine, because our wart was still very nice here, okay. So this was crude oil. In fact, the crude oil, as I remember from there, then reversed to the upside, which was also expected, because as you know, after every 5 waves, market will reverse in opposite direction minimum in 3 legs, okay. And here we have also a second example. We have example of natural gas. This was shared recently. It actually played out very, very nicely, so we will look also on this example. You can see here on the 4-hour chart, we identified 3 waves to the downside, impulse to the upside, okay. Now, when the market moved above and out of this channel, very similar to this crude oil, when crude oil fell out of this bullish channel, I was starting to looking for a bullish opportunity on natural gas, okay. We don't know if market at this stage will continue straight to the upside, or will maybe make a pullback as shown here and then move to the upside. In either case, if you have your strategy very well defined, you can buy 50% of your risk of your normal position size at market and maybe at lower levels. Okay, ideally you will see a wave 2 pullback, and then you will add at lower levels with stops on both positions, obviously at invalidation levels. Okay, this is example of a futures market. This, of course, obviously risk is very huge here, but you can look at other correlated markets, ETFs from natural gas maybe. So here, obviously, I was looking to the upside, and as you can see on this next chart, market made nice pre-waves. It found a bottom at this wave A. If you are also like the old school analysis, like head and shoulders pattern, you will see that this was actually an inverse head and shoulders pattern, left shoulder, head, and right shoulder, and market then accelerated extremely nicely to the upside here. Okay, so at this stage, of course, after a break to a new high, I always will pull my stops higher and make risk very tight. So in such case, when you see something like this, you definitely want maybe to lock in some profits or make a very tight stops. Okay, definitely in this region you would pull stops into this wave 1 invalidation level, and I would suggest to close some percentage at projections for wave 3. Okay, now if anyone has any questions here, please let me know. So you can see here that actually difference between these charts, crude oil and natural gas, is that on natural gas, actually let me firstly explain here on crude oil, this first impulse when I entered the trade was very small. Okay, downside potential was huge, while here you would say, why didn't go into the trade here? Well, because at this stage we were still below this wave A. You definitely want to see an overlap with wave A before you may confirm a reversal in trend, because you never know if maybe this is wave 1, wave 2, 3, 4, 5 wave move to the downside, or it's really a zigzag. So I didn't want to go in here. Definitely, I always want to wait on a break out of this channel. Okay, this will then confirm the idea that counter-trend price action is complete and that market is heading in the direction of a larger trend, which in natural gas was to the upside. Okay, so now I will also cover this example of a triangle. Now here we have a triangle which occurs in bull market. The triangle is a 5-wave pattern, A, B, C, D, and E. So you, when you see contracting trend lines in the middle of a larger uptrend, you of course will pay attention to these 5 subwaves. If you will spot 5 subwaves, then you may be interested to go long that market. So here on the aggressive approach, you would look for an entry at the lower side of the range with protective stops, not below wave C, but I recommend below wave A, because if you want to jump in on the other side of a range, then obviously you will have to have stops beyond the range levels, okay, which in our case suggests to be below wave A on a triangle. If you are more patient trader, then you will definitely wait on a break of the wave D, because here in wave E, you actually don't know if the wave E will really bottom here and reverse from the trend line, or if the market will continue lower and it may be something more complex is in the cards here. So when you have this reversal to the upside through the upper side of a triangle, then this is nice confirmation that market is heading to the upside. So in such case, you would place stops below this wave A, okay? Yes, wave E, not wave A. So in a bear market, actually very similar. Let's say that larger trend is down here and we have went sideways. Wave E for aggressive traders should be interesting for shorts at the upper side of the range with protective stops above wave A, and here at the wave D low would be entry for patient traders with protective stops above wave E. Okay. Now here we have also now example of on dollar yen that played out over the last few weeks. So here on dollar yen, as I said earlier, I always want to see what is the larger trend before I will look for any trading opportunity. Okay. So here on the weekly chart, I identified an uptrend trend. Here clearly move up, down, which is correction, strong move up, sideways, which is correction. Okay, so looks like more upside is in the parts here. And so I went to the lower time frame, and here we have a triangle. We identified a triangle on a daily chart, and if you're an aggressive trader, you will do what? You will do or enter a long position at this lower side of the range, which you suspect it's wave E. But as I said earlier, you are not sure if that's wave E. What if the market will maybe move to the downside and this will prove to be a wave B triangle? This whole decline would be A, B, C. Okay, so in such case, in aggressive approach, you definitely want to enter a trade with lower position size. Okay, so I would suggest to enter at wave E levels if you're an aggressive trader with 50% or less of your normal position. Okay, with stops definitely beneath wave A, because this wave E, if you think that's wave E, can always become maybe even more complex wave C. Okay, and then you will be stopped out here if you put stops below wave C, but the market still may go sideways and then to the upside. So if you're a patient trader, then obviously you will wait on this break of wave D, okay, and put the stop loss below wave E. So in such case, even if you move, even if you will think that you missed this nice move here, if we go to 150, well, keep in mind that upside potential is still very huge. Okay, so let's take a look how this unfolded. So you can see that market moved into a new high, which is expected for a wave 5. We have seen here 5 waves to the upside. So if you're an aggressive trader and you got an entry here, you will definitely close some percentage at this upper side of a range, because if you go in the market at the lower side of a range, you definitely want to close some percentage at the upper side of a range. If you're a patient trader and you got in at the break of the range, then obviously you will look for stops below the range, okay, which is below the wave E, and we look for a move to the upside. Okay, so you can see here that market moved nicely to the upside. It's not an ideal move. You can see here from a risk to reward perspective. You can see here that this is, let's say that it's 1-to-1. Okay, but definitely always, as I said already earlier, when you see a new highs, there are a lot of orders, a lot of new traders want to get involved, especially institutions. So this always, or in most of cases, it's very important zone from where market could reverse rather than continue in the same directions. Okay, so that's a psychological game from the market. So you definitely want to make very tight stops when you see new highs. Okay, because you never know when wave 5 will reverse and complete the pattern. Okay, so now if you have any questions, please let me know. Otherwise, we will proceed. Okay, I need also to explain and what is a comfort zone of investment. Okay, so if you're an aggressive trader, as I said earlier, you definitely want to get involved in the market with lower position size. Okay, now if you don't sleep well, if you're looking at the market quotes when on mobile, when you are, I don't know, on the road, out of the office, and you're watching these quotes every second, then obviously I suspect that you are involved in the market with very high risk. Okay, but if you want to be very calm when it comes to trading, if you want to sleep very well and forget on the FX on or other markets for a few hours or a few sessions, then you definitely need to know what is your comfort zone of investment. This is the zone, the risk that you are not scared to lose. Okay, that is very important. Don't be scared to lose your investment, because obviously you cannot win all the time. Okay, in fact, an uncomfortable trader or investor may allow emotions to take control of their trading decisions. But definitely you don't want that your trading decisions will be impacted by emotions. Okay, you are the man who needs to control trading with your proven strategy, with your technical analysis, with your forecast that was with your trade plan. Okay, forget on emotions, and only this can be if you have very well defining your comfort zone of investment. Okay, it also minimizes the possibility of high pressure situations or hard decisions. So, for example, you don't know if you would go sell or buy, or if you already missed some of the moves. So what now? Well, if your comfort zone is very small risk, at least at me, is I don't have a problem to buy or sell the market if the risk is very small compared to the normal position size. Okay, so this is my comfort zone, very small risk. Okay, in fact, if you trade small, you can only lose small, and there is always possibility to win big. But if you trade big, very large amounts, you can win big, which is true, but you can lose all as well. Okay, so if you trade big, you cannot lose small. Okay, so firstly, the most important is that you understand and know how to save your money. Okay, in the first year of your trading, first 2, maybe first 3 years, you will be happy if you will not lose your money. Okay, and you can achieve this only if you will define your comfort zone, your very small risk of investment that you are prepared to lose. Okay, and that you are not scared to give money to some others. Okay, so how to define your comfort zone? Firstly, you need to define your normal position size. In markets, the normal position size is usually, like everybody is saying, which I still think it's high, it's 3% in the FX. Okay, so if you are looking for a comfort zone, I would suggest to split this 3% on 3 or 4 equal parts. Let's say smaller risk 1%, 2%, and then 3%. Okay, the lowest part, the 1% in this case, is your comfort risk. So if you're having very hard decisions, if you would enter a trade or no with 3%, well, guess what? Go and minimize this risk to 1% or even lower to 0.5%, and then I guess you will minimize the pressure, definitely. Okay. So now I guess the time is going very fast here. So now we will also take a look at markets. Here I'm looking at, I want to show you my live trading approach, okay? So on dollar yen, for example, you can see here chart now, dollar yen, we can see uptrend in progress. So obviously I want to look in the direction of an uptrend on the larger trend. And then if the larger trend is up, I will switch to a lower time frame, let's say to 4 hour. And on the 4 hour chart, as you said earlier, you will want to trade a zigzags in the direction of a larger trend. I can see here 3 waves of decline, A, B, potentially wave C, or maybe even more weakness in coming sessions before this wave C will be completed. Okay, so from a trading perspective, as we said, from a confirmation point of view, this could be market on my radar screen, okay, and I may look for new opportunity here, but as I said earlier, you want a confirming price action that is an impulsive reversal. Just let me label this, an impulsive reversal from the end of wave C in impulsive fashion through the upper side of the corrective channel. When or if this will happen, we don't know, but when it will happen, I will be definitely interested to go along on this pair, okay? Now I was also intending to show you crude oil, but unfortunately I must finish here. So quick, if anyone has any questions, please let me know. Regarding the trading and not Fibonacci projections, because Fibonacci projection, this will be covered. It's a huge topic for some other webinar, okay? So actually, if you're interested in our services, we are doing live Elliott wave analysis at ew-forecast.com, okay? And if you want, you can check our website. We are doing and covering a lot of markets on a daily basis, all major FX pairs, including crude oil, gold, and the S&P 500. Okay, so if you're interested, please visit our website. We also have a lot of videos, a lot of intraday updates, which means we are active during the day, especially during European and US training sessions. So please check our services. Also, on the FX Street, we have a special offer for lower fee. I guess that FX Street will give you a link in this chat room. So if you're interested, please check it, and you will get a free trial, absolutely free for 10 days, okay, through the FX Street. So thank you everybody for attending, and I hope to see you next time. Have a good day. Bye.